Markets are in shock. The sudden U.S. move in Venezuela and President Trump's fiery speech have sent ripples across global markets. Energy giants, refiners, service providers, and defense contractors are all reacting. Here are the 5 stocks most exposed to this geopolitical earthquake. Chevron's stock currently trades around $155, reflecting heightened volatility in the wake of U.S. actions in Venezuela. In the immediate term, analysts expect swings between -2% and +3% as markets digest the disruption of crude flows. Looking further out, if supply stabilizes, midterm growth could range from +3% to +8%. The company is directly affected by the revocation of its license to operate in Venezuela, forcing a wind down of joint ventures and cutting off access to heavy crude barrels that once fed its refining system. Despite this setback, Chevron's diversified upstream portfolio acts as a shock absorber, helping cushion the impact of sanctions and geopolitical instability while maintaining resilience across its global operations. ExxonMobil's stock currently trades around $122.65, reflecting its position as one of the world's largest integrated energy companies. In the immediate term, volatility is expected between -1% and +3% as markets react to uncertainty in heavy crude flows following the Venezuela crisis. Over the mid-term, if global demand stabilizes and supply chains adjust, growth could range from +2% to +7%. Exxon is affected because its refining system is highly sensitive to the availability of heavy crude, much of which has historically come from Venezuela. The company's integrated model, balancing upstream production with downstream refining and chemicals, provides flexibility to preserve margins, even when feedstock mixes shift. This operational resilience helps Exxon absorb geopolitical shocks while continuing to meet global energy demand. Valero Energy's stock currently trades around $165.32, positioning it as one of the largest independent refiners in the United States. In the immediate term, volatility is expected between -3% and +4% as crack spreads react to uncertainty in heavy crude imports following the Venezuela crisis. Over the mid-term, if supply stabilizes and alternative sources are secured, growth could range from +5% to +2%. Valero is particularly affected because its refining system is optimized for heavy crude, much of which has historically been sourced from Venezuela. Any disruption in these flows directly impacts margins and profitability. Despite this risk, Valero's complex refining capacity allows it to adjust feedstock mixes, though often at higher costs. The company's dependence on heavy barrels makes it one of the most sensitive players to geopolitical shifts in Latin America, tying its fortunes closely to the stability of Venezuelan supply chains. Schlumberger's stock currently trades around $40.21, reflecting its role as the world's largest oilfield services provider. In the immediate term, volatility is expected between -2% and +5% as investors weigh the impact of geopolitical instability on drilling activity. Over the mid-term, if Latin American fields reopen and exploration budgets recover, growth could range from +6% to +2%. Schlumberger is directly affected by the Venezuelan crisis because its services are tied to the health of regional oil production. Any disruption in Venezuela delays contracts and reduces demand for drilling and maintenance programs. However, the company's global scale and technology leadership position it to capture new opportunities quickly if operations resume. This makes Schlumberger a critical player in how the energy sector responds to shifting geopolitical realities in Latin America. Lockheed Martin's stock currently trades around $497.01, reflecting its position as the leading U.S. defense contractor. In the immediate term, volatility is expected between +1% and +4% as heightened geopolitical risk drives investor interest in defense equities. Over the mid-term, if defense budgets expand in response to global instability, growth could range from +4% to +10%. Lockheed is affected by the Venezuela crisis indirectly. Rising tensions and uncertainty increase demand for advanced defense systems, from fighter aircraft to missile defense. The company's backlog, exceeding $150 billion, provides long-term revenue visibility, while its diversified portfolio across air, land, sea, and space ensures resilience. As geopolitical shocks ripple through markets, Lockheed Martin stands out as a beneficiary of increased security spending and strategic realignment. The Venezuela crisis is more than a regional headline, it's a global market shock. Energy companies confront supply chain risks, refiners struggle with margin swings, service providers anticipate new contracts, and defense primes stand to benefit from rising budgets. For investors, the lesson is unmistakable: geopolitical events can reshape strategies overnight. Stay alert, stay diversified, and keep connecting the dots between politics and profits. Now it's your turn. Share a comment on what you'd like me to cover next. Don't forget to like and subscribe if you want more market insights delivered straight to your feed. After all, the only thing more volatile than oil prices is the YouTube algorithm. This video is for informational purposes only and does not constitute financial advice. Invest at your own risk.